In 1907, the American economy was collapsing. Banks were failing. The stock market had lost half its value. Panic spread across 73 cities. The United States government had no power to stop it, no central bank to intervene, no mechanism to inject liquidity into the system. So one man stepped in, J.P. Morgan. He summoned the most powerful bankers in New York to his private library on Madison Avenue, locked the doors, and refused to let them leave until they committed $25 million to save the banking system. By morning, the panic was over. Morgan had single-handedly prevented the collapse of American capitalism. But here's what you need to understand. That rescue wasn't an act of patriotism. It was a demonstration of power. Because by 1907, J.P. Morgan didn't just control banks. He controlled railroads, steel, electricity, and the capital markets that funded every major American industry. He owned 21 railroads. He created U.S. Steel, the first billion-dollar corporation. He formed General Electric. He controlled the money supply before a central bank existed. And when the government finally created the Federal Reserve in 1913, it was designed using Morgan's blueprint, staffed by Morgan's men, and structured to institutionalize the power Morgan had wielded privately for decades. J.P. Morgan didn't just save American capitalism. He built the architecture of financial control that governs your life right now in 2025. Every time you take out a mortgage, you're using Morgan's system. Every time the Federal Reserve adjusts interest rates, it's using Morgan's institutional design. Every time a bank merger creates a financial giant too big to fail, it's following Morgan's consolidation playbook. The man who controlled America's economy didn't die in 1913. His system became permanent and you cannot escape it. Let me show you exactly how Morgan built this system, how he used financial crises to consolidate power, how he created the template for modern banking, and why 112 years after his death, the American economy still operates according to J.P. Morgan's rules. John Pierpont Morgan was born April 17, 1837, in Hartford, Connecticut. His family wasn't just wealthy, they were banking aristocracy. His paternal grandfather, Joseph Morgan, co-founded Aetna Insurance. His maternal relative, James Pierpont, founded Yale University. His father, Junius Spencer Morgan, was a partner in a London merchant banking firm. Morgan wasn't a self-made man. He was born into the system and trained from birth to control it. This is crucial to understand. Morgan didn't compete his way to the top. He inherited access to European capital markets, relationships with the Rothschilds, and connections to every major financial institution in the Western world. By the time he started his banking career in 1857, he was already positioned at the center of global finance. Morgan studied in Switzerland and Germany, learning French and German fluently. He understood that finance was international, that capital flowed across borders, and that whoever controlled the flow of money between Europe and America would control American industrial development. In 1871, Morgan partnered with Philadelphia banker Anthony Drexel to form Drexel, Morgan & Co. The firm served as the American agent for European investment. This was Morgan's genius. He was the bridge. European investors had capital. American industries needed capital. Morgan stood in the middle, taking fees on every transaction, building relationships with both sides, and accumulating power with every deal. By 1895, the firm was reorganized as J.P. Morgan & Company. And by then, Morgan wasn't just a banker. He was the lender of last resort for the United States government. In 1895, the U.S. Treasury was running out of gold. The gold standard required the government to back every dollar with gold reserves. But a depression had drained those reserves. The government was on the verge of defaulting, which would have destroyed America's credit and collapsed the economy. President Grover Cleveland had no options. Congress refused to help. So he turned to J.P. Morgan. Morgan organized a syndicate of bankers, including the Rothschilds, to sell $62 million in gold directly to the Treasury in exchange for 30-year bonds. The rescue worked, the Treasury was saved. But Morgan made a fortune on the deal, and critics accused him of profiting from a national crisis. This is Morgan's pattern. Financial crisis creates opportunity. When everyone else panics, Morgan consolidates, and every crisis makes him more indispensable. Because after 1895, everyone knew, when the government needs saving, call Morgan. But Morgan's real empire was railroads. By the 1880s, railroads were the most important industry in America. They connected markets, transported goods, and made industrialization possible. But they were chaos. Hundreds of railroad companies competed ruthlessly, drove prices below cost, went bankrupt, and destabilized the entire economy. Morgan saw the problem. Competition was killing profitability. So he solved it the only way bankers know how. Consolidation. Morgan began reorganizing bankrupt railroads. He brought in new management, restructured debt, and merged competing lines. The term for this was Morganization. When a railroad was Morganized, it meant Morgan took control. He installed his men on the board of directors. He dictated management decisions. He ensured the railroad served Morgan's interests, not just its shareholders. By 1902, Morgan controlled 5,000 miles of American railroads. That's not an investment, that's an empire. But railroads weren't just about transportation. They were about control. Whoever controlled railroads controlled the movement of goods, the pricing of freight, and the economic development of entire regions. Morgan didn't just own railroads. He owned the industrial supply chain. This is where Morgan's power became structural. In 1901, Morgan created the Northern Securities Company, merging three major railroads: Northern Pacific, Great Northern, and the Chicago, Burlington, and Quincy. This gave Morgan a monopoly over rail traffic in the Midwest and Northwest. President Theodore Roosevelt, the so-called trust buster, sued to break it up under the Sherman Antitrust Act. In 1904, the Supreme Court dissolved Northern Securities. But here's the thing, Morgan didn't lose money. His railroads were still profitable. His control over transportation was barely diminished. And the Supreme Court decision only proved what Morgan already knew. You don't need a monopoly if you control the financing. Because even after Northern Securities was broken up, every railroad that needed capital came to Morgan. Every merger required Morgan's approval. Every restructuring went through Morgan's bank. The structure was dissolved, but Morgan's power remained. But railroads were just the beginning. In 1901, Morgan executed the deal that would define his legacy and create the template for corporate consolidation for the next century. He created United States Steel Corporation. Here's how it happened. Andrew Carnegie owned Carnegie Steel, the most efficient steel producer in the world. Morgan owned Federal Steel, the second largest producer. Carnegie was threatening to vertically integrate, building his own finishing plants to compete with Morgan-backed companies like National Tube. This terrified Morgan. Carnegie could crush Morgan's steel investments through competition. Morgan's solution? Eliminate the competition by buying Carnegie. In December 1900, Charles Schwab, Carnegie's president, gave a speech to New York's financial elite about creating a steel super trust. Morgan was mesmerized. After the dinner, Morgan and Schwab met in Morgan's private library and talked through the night. Morgan decided immediately, buy Carnegie Steel and merge it with every other major steel company in America. Schwab went to Carnegie with Morgan's offer. Carnegie scribbled his price on a piece of paper, $480 million. Morgan accepted without negotiation. On February 25, 1901, United States Steel Corporation was incorporated. The deal combined Carnegie Steel, Federal Steel, National Tube, American Steel and Wire, American Bridge, and Lake Superior Consolidated Iron Mines. Total capitalization, $1.4 billion, the first billion-dollar corporation in human history. To put that in context, the entire U.S. federal budget in 1901 was $517 million. U.S. Steel was nearly 3 times larger than the government. This was Morgan's genius. He didn't invent steel. He didn't run steel mills. He organized steel production under a single corporate structure that eliminated competition, controlled pricing, and generated returns for his bank. U.S. Steel controlled 67% of American steel production. That's not a company. That's a cartel. And Morgan sat at the center, collecting fees on every transaction, holding board seats on every subsidiary, and dictating terms to an entire industry. When Carnegie walked out of Morgan's office after selling, Morgan reportedly told him, "Congratulations on becoming the richest man in the world." Carnegie's response, "You're the real winner here, Pierpont." Carnegie was right because Morgan didn't just control steel. He replicated the model across every major industry. In 1892, Morgan merged Edison General Electric with Thomson Houston Electric to form General Electric. He installed his men on the board. GE became the dominant electrical equipment manufacturer in America. In 1902, Morgan created International Harvester, consolidating 85% of the farm equipment industry under one company. In 1902, He financed International Mercantile Marine, attempting to monopolize transatlantic shipping. By 1912, J.P. Morgan and his partners controlled companies with combined assets of $22.2 billion. That was equivalent to the value of all property in the 22 states west of the Mississippi River. One bank, one man, controlling more wealth than half of America. This is the system. Identify fragmented industries. Use financial crises to buy distressed companies at low prices. Merge them into consolidated trusts. Place Morgan partners on every board. Control pricing, eliminate competition, and extract monopoly profits. Rockefeller did it with oil. Morgan did it with railroads, steel, electricity, shipping, and banking itself. But Morgan's consolidation wasn't limited to industry. He was also consolidating financial power. Through interlocking directorates, Morgan placed his partners on the boards of hundreds of corporations. If you served on the board of U.S. Steel, you also served on the board of National City Bank. If you were on the board of General Electric, you were also on the board of AT&T. Every major corporation was connected through Morgan's network. This wasn't capitalism. This was coordinated control. In 1912, Congress investigated the Peugeot Committee, named after Louisiana Representative Arsène Peugeot, held hearings to determine if a money trust existed, a small group of financiers who controlled American banking and industry. Morgan was called to testify. He was 75 years old, in declining health, but still the most powerful banker in America. The committee asked, "Do you control these corporations?" Morgan's answer was a masterpiece of evasion. "I do not control them, I influence them." But the Peugeot Committee's final report was damning. It concluded that Morgan and a handful of banks controlled aggregate resources of $22.2 billion through interlocking directorates. The report stated that this concentration of financial power was the greatest monopoly in the world. But here's the thing, nothing happened. No laws were passed to break up Morgan's empire. No criminal charges were filed. The money trust was exposed, and America just accepted it. Because by 1912, Morgan's power wasn't optional, it was infrastructure. You couldn't break up Morgan without breaking up American industry. Morgan died on March 31, 1913 in Rome, Italy. He was 75 years old. His estate was valued at $80 million, about $2.5 billion today. That sounds like a lot, but it's not. John D. Rockefeller was worth $400 billion inflation adjusted. Andrew Carnegie was worth $310 billion. Morgan's personal wealth was a fraction of theirs. So why was Morgan more powerful? Because Morgan didn't need to own everything. He controlled the capital that funded everything. Ownership is a liability. Control is power. Rockefeller owned oil. Carnegie owned steel. Morgan owned the banks that financed oil and steel. And when you control financing, you control everyone who needs money, which is everyone. But here's Morgan's most enduring legacy. 8 months after his death, Congress passed the Federal Reserve Act, creating the central bank that Morgan had argued for his entire life. The Federal Reserve was designed at a secret meeting in November 1910 at the Jekyll Island Club off the coast of Georgia. Who attended? Senator Nelson Aldrich, chairman of the National Monetary Commission and father-in-law of John D. Rockefeller, Jr., Henry Davison, senior partner of J.P. Morgan and Company, Paul Warburg, representing Kuhn, Loeb & Cobers, a Morgan-allied bank, Frank Vanderlip, president of National City Bank, the Rockefeller Bank, Benjamin Strong, representing J.P. Morgan's interests, who would become the first governor of the Federal Reserve Bank of New York. The meeting was secret because the men knew the public would never accept a central bank designed by Wall Street bankers. So they crafted a plan that appeared decentralized, 12 regional reserve banks overseen by a Federal Reserve Board, but structured to ensure New York, meaning Morgan's bank, controlled monetary policy. When the Federal Reserve Act passed in 1913, it institutionalized Morgan's power. The Fed could do what Morgan did in 1907, inject liquidity into the banking system during crises. But now it was permanent, legal, and shielded from democratic accountability. The Federal Reserve is not a government agency. It's a hybrid, part public, part private. The 12 regional banks are owned by private banks. The Board of Governors is appointed by the president but operates independently. This structure was designed to give bankers control while maintaining the appearance of government oversight. And here's the proof it worked. The Federal Reserve Bank of New York, the most powerful of the 12 regional banks, has always been controlled by the largest banks: J.P. Morgan Chase, Citigroup, Bank of America, the same institutions that descended from Morgan's empire. The Fed doesn't regulate these banks, it is these banks. Morgan's consolidation strategy became the blueprint for modern finance. In 1999, Congress repealed the Glass-Steagall Act, which had separated commercial and investment banking since 1933. This allowed commercial banks to merge with investment banks, insurance companies, and brokerage firms. The result? J.P. Morgan Chase, the descendant of Morgan's bank, is now a $3.9 trillion institution that combines commercial banking, investment banking, asset management, and trading. Bank of America, Citigroup, and Wells Fargo followed the same model. In 2008, when the financial system collapsed, these banks were bailed out by the Federal Reserve. The Fed lent trillions of dollars at near zero interest rates to save the banks that own the Fed. This is Morgan's system. When banks fail, the Fed rescues them. When the economy crashes, the Fed injects liquidity. And the banks that benefit from Fed policy are the same banks that control Fed policy through ownership of regional Federal Reserve banks and interlocking board memberships. You cannot separate the regulators from the regulated because they are the same people. Let me show you how this system extracts wealth from you. You take out a mortgage. The interest rate is set by the Federal Reserve, but the Fed's policy is influenced by the largest banks, which profit from mortgage lending. So the system is designed to maximize bank profit while appearing neutral. You use a credit card. J.P. Morgan Chase, Bank of America, Citigroup, and Wells Fargo control 43% of the U.S. credit card market. They set fees, interest rates, and terms. You have no choice but to use their system. You invest in the stock market. The market is dominated by a few massive asset managers: BlackRock, Vanguard, State Street. These firms control trillions in assets and own significant stakes in every major corporation. This is the long-term consequence of Morgan's financial architecture. Over time, financial power becomes concentrated, monetary policy becomes centralized, and large institutions gain increasing influence over how money flows through the economy. When governments run budget deficits, they finance them by issuing treasury bonds. These bonds are underwritten and traded by major financial institutions. The same banks that participate in these markets are deeply connected to the Federal Reserve System, which manages interest rates and liquidity. This creates a closed financial loop where public debt, private capital, and monetary policy continuously interact. This structure favors scale. Larger banks can access capital more cheaply, manage risk more efficiently, and influence policy discussions through their role in the financial system. Smaller institutions, facing higher costs and tighter regulations, often merge or exit the market. Over time, consolidation becomes the dominant trend. The same pattern appears in consumer finance. A small number of banks dominate mortgage lending, credit cards, and payment networks. Interest rates, fees, and lending standards are shaped by centralized monetary policy and market concentration rather than individual choice. Participation in modern economic life increasingly requires engagement with these large institutions. This is not the result of a single decision or secret agreement. It is the outcome of incentives built into the system itself. Policies designed to stabilize markets during crises tend to strengthen the largest players. Each intervention reduces volatility but also increases concentration. Stability is achieved, but at the cost of decentralization. Morgan's system did not rely on ownership of everything. It relied on controlling the financial framework that everything depends on. That framework rewards consolidation, reinforces scale, and channels economic activity through a small number of institutions. Once established, such systems persist not because they are hidden, but because they are functional. The gemstone Morganite was named in his honor. This wasn't vanity, this was legacy building. Morgan understood that controlling wealth wasn't enough. You had to control culture, education, and history. His art collection shaped what Americans saw as valuable. His library shaped what was preserved. His philanthropic gifts shaped institutions that still educate and influence the public today. But Morgan's legacy isn't just museums and gemstones. It's structural. The Federal Reserve uses Morgan's institutional design. The banking system uses Morgan's consolidation strategy. The capital markets use Morgan's interlocking directorates. Every financial crisis follows Morgan's pattern: panic, bailout, consolidation. The 1907 panic led to the Federal Reserve. The 2008 crisis led to Dodd-Frank, which institutionalized too big to fail by designating certain banks as systemically important. These banks get special oversight, but they also get implicit guarantees. They can't be allowed to fail because their failure would collapse the system, so they take bigger risks knowing the Fed will bail them out. This is moral hazard, and it's built into the system Morgan designed. Morgan's grandson, Junius Spencer Morgan III, continued the family banking dynasty. Morgan's son, J.P. Morgan Jr., led the firm during World War I and arranged over $3 billion in loans to Britain and France. The firm financed the Allied war effort, cementing its role as America's most influential bank. During World War II, Morgan Stanley, founded by Morgan's grandson Henry Sturgis Morgan, became one of Wall Street's premier investment banks. Today, J.P. Morgan Chase and Morgan Stanley are two of the most powerful financial institutions in the world. Both descended from the empire J.P. Morgan built between 1871 and 1913. The Morgan family's direct control ended, but their institutional control became permanent. So what do you do? How do you respond to a system you cannot escape? 3 options. 1. Accept it. Understand that financial consolidation is the natural result of advanced capitalism. Use the system, borrow from banks, invest in stocks, participate in the economy. Accept that wealth will concentrate at the top, because that's how Morgan designed the system to function. 2. Resist it. Support financial regulation. Break up the big banks. Push for public banking. Vote for politicians who promise structural reform. Recognize that resistance is exhausting and often futile, but believe that incremental change is possible. 3. Understand it and position accordingly. If you cannot escape the system, position yourself to benefit from it. Buy stock in J.P. Morgan Chase, Bank of America, and the financial institutions that control the system. If wealth concentrates in the banks, own the banks. If the Federal Reserve's policies inflate asset prices, own assets. This isn't investment advice, this is pattern recognition. The Morgan system has concentrated financial power for 150 years. It will continue because it's embedded in law, regulation, and institutional design. Fighting it is noble. Escaping it is impossible. Understanding it and adapting to it is pragmatic. J.P. Morgan died in 1913, but his system didn't. The Federal Reserve was created using his blueprint. The banking consolidation he pioneered has only accelerated. The interlocking directorates he established are now asset management firms holding trillions. The crisis bailout consolidation cycle he demonstrated in 1907 was repeated in 2008 and will be repeated in the next crisis. Morgan's genius wasn't building wealth. It was building infrastructure. He didn't need to own steel, railroads, or electricity. He controlled the capital that financed them. He didn't need a monopoly. He controlled the financing that every monopoly required. And when the government finally created a central bank, it was designed to institutionalize the power Morgan had wielded privately. This is the Morgan system, not U.S. Steel, not General Electric, not J.P. Morgan Chase. The method. Crisis creates opportunity. Consolidation eliminates competition. Interlocking control coordinates power. And financial infrastructure makes the system permanent. You live in Morgan's America. Every mortgage, credit card, stock investment, and Federal Reserve decision follows rules Morgan established between 1871 and 1913. You didn't choose this system, but you cannot escape it, because the system isn't a company. It's the structure of American finance, and that structure was designed by J.P. Morgan. The man who controlled America's economy didn't just save it in 1907. He built the architecture that ensures wealth and power flow to the top. Crises consolidate control, and escape is impossible. Welcome to Morgan's America.